Big on the mic, bring the facts. Erin in the ring, no turning back. Kobe got the numbers clean and clear. Experts in the mortgage space right here. Housing issues, yeah, we dig deep. Every word weigh when the stakes don't sleep. Credit war, you can feel that charge. Every point hit hard, every stance large. Capital Hill, that pressure stay high. Consolidation makes the small ones fight. Servicing trails, every detail counts. Say it plain, then we write it out. No surrender.
Hello from the other side.
What's up, Adele?
Looks chilly.
Hey,
there.
Kobe, what's the weather like over there?
I have no idea. As you know, I work remotely, and I'm inside now, so there's really no way for me to know. And I wouldn't want to give you wrong information. So
I wouldn't want you to think I would think you were AI, honestly.
Yeah. Well, a lot of people ask me that, but I'm actually a real person, even though I have no idea what the weather is.
Yeah, it's amazing. Hey, how do you like my garb today? Is this good?
It's beautiful.
Pretty hot, huh?
The homage to Adele is uncanny.
Well, it was either this or what I'm actually wearing, which, it took you guys seconds to ask me if I was a tablecloth, if I had been on an interview. What was the other question?
I asked if you're in court today.
So this is Vince, man. Don't you know Vince? Not a good look, huh?
It's a nice shirt. We're just not used to seeing you in, with a real shirt.
Right.
It's funny. I thought about wearing just the normal sweatshirt that I always wear, and then I went to the closet. I'm like, I'm going to change it up, because I think that my co-hosts will be really impressed. And I think I may have missed the mark.
You overjudged us for sure.
I did. I gave you way too much credit. We have a lot to go over today, including a direct-to-consumer encounter that I personally had as a consumer. How about that? But first, have you guys had a good week so far?
Amazing.
This has become the highlight of my week, just so you know. So very excited to get this moving here. Let's recap last week. Let's start there, because last week I had brought up concerns about non-QM loans, seeing what I'm seeing the momentum in the space, seeing the overzealous nature of investors wanting to pay very well for these loans, the DSCR component with rental income. Here's a little summary of that conversation. Then we're going to get to some stats that just hit the tape, literally hours ago.
I don't think we're going to get to a point where we have to worry about these loans the same way we had to worry about the subprime prices. That's
I don't know how you can call it negligible. It's growing in a big way.
It's not nearly as scary as what could be happening on the FHA space. I think this is not going to be anywhere near what subprime was, but I do think that lenders need to be very cautious about the loans that they are offering in this non-QM space.
Yeah, and I think we all agreed there, right? And I think, Kobe, you followed up with a post of your own about the non-QM space, but then I'm curious to know if anything has changed from your perspective, seeing what we're looking at right now. This is a non-QM performance snapshot from April 2026 from DV01 Research. Erin was kind enough to, you can see I summarized this I used AI, everybody, by the way, just so you know. I'm admitting it. I used AI. What stands out, Erin, when you look at this? And has your concern level at all risen even 1 decibel?
Obviously delinquencies are climbing, which is kind of why we started having that conversation to begin with. And so, the thing that stands out to me is the kind of in the middle, the cure rates, because I've been watching this and as delinquencies have risen, we have in the past seen where subsequently cure rates, or when they were able to bring the loans current, they improved. Seeing the cure rate fall, meaning that's fewer loans that are being brought current from the prior reporting cycle, that is definitely concerning to me. And so, I think, again, there are those non-QM loans that are just the non-traditional documentation loans. I think that those still are a very good book, but I think especially DSCR space, especially if you're looking at the near miss product, I think that those are definitely going to be challenged, and we need to be watching it.
Kobe, roughly 1 in 14 non-QM loans is in some form of trouble. Impairments at 7.3%. One thing I love about you it's probably too early for you to make this call. Is you're always willing, and I try. This is like if someone said, "What has Coby taught you as a friend?" It's to be open-minded and to be willing to pivot and change and alter as you get more data. So when you see this, any elevated concern on your part with how this is trending?
Elevated concern, no, but it did as you pointed out, it opened up that there's some nuance here that we should be addressing, which is, first of all, the cure rate. We'll talk about that for a second. The cure rate is also a function of the macroeconomic picture. It's a function of what are interest rates in order to refi out of a property. Can you sell the property? Those are things that, from a macro level, and the cure rates on the conventional loans have also cratered as a result of the economic conditions. So I think there's a macro element there that is at play that is not necessarily speaking to the effectiveness of these loans or the performance of these loans. So we could see that change, and I think we will if we get some lower rates and a little bit more movement. What I did notice in these numbers that did kind of open my eyes a little bit is that the marginal loans, the ones that are the no doc, the stated income, or whatever we're doing on the bleeding edge of the non-QM or the non-agency, as Jen McGinnis called it on a MBA call that I was on this week, and I love that. Let's call it non-agency, not non-QM. The loans that have the most amount of opportunities for fraudulent statements or for stated income, bank statement loans, whatever somebody can do to get a loan on terms that are favorable that they don't actually deserve. That's where the problem is. That's where we had the problem back in the day with those loans. So I think those are a small part of non-QM or non-agency right now. And I think those are the ones that we should be watching out for. But we're still looking at delinquency rates that are half that of FHA. And Erin, you pointed out that you were more concerned about FHA, and she's right to be. It's a much bigger piece of the business, and the delinquency rates are 2x. So I still think we're not at a point to be clutching our pearls over these loans, but we should be paying attention to them for sure.
Yeah, I mean, I'll just continue to point out the environment that we're in right now. It's getting tough for people out there, and rents are declining in a lot of areas. So to think that this is going to get better when the majority of these loans, majority meaning more than 50%, are tied to rental income and an expected rental income, not just this year, but next year and the year after that, it just, you add to that the homeowners insurance. You know, Coby, another great post you made about affordability and mortgage payments this week. You've really been on fire, by the way. Your LinkedIn
And
is a
Fuego.
must follow, bro. You're literally fuego.
Thank
Do
you.
we expect tighter guidelines, or we just have a keener eye observing here, pay closer attention?
I think it's too early to tell. I think we need to get through and see what the next few months look like. If we see continued deterioration, yeah, I think on the margins we will see some changes, but I think it's too early to tell.
Okay, excellent. All right, you guys ready to jump into this experience that I had with?
Let's go.
Well, so let me tell you a little story. All right, you guys like stories?
Yes.
Yeah, let me get my
Great.
hot cocoa.
I'm going to tell you one. First, I'm going to remove this slide. So I'm looking to potentially send my kid to public school in an area that we don't live in. So I just, on a whim, went around looking in my area for schools in my kid's district as a consumer, by the way, as a customer, right? Other side of the table. Somehow landed on this website. This is the property that I was looking at, right? Pretty innocuous, innocent looking little townhouse in the same district. I hit message agent. Okay. Message agent, right? So you'd think you're expecting to message an agent, right? So up comes this message agent, very consistent. I'm about to message the agent. So I put my name, I put my email, I put my phone number, I hit go thinking I'm going to message the agent. But that's not what happened. What happened was I got 6 emails in less than 30 minutes, an immediate phone call, 2 text messages. And by the time it was all said and done, just 3.5 days later, I had all these emails from Movoto. Movoto is pretty big in the space. I mean, I think they're in the top 5 as far as, web traffic. And by all accounts, great company. I don't have anything to say about them bad. I've not seen anything bad out there, but the experience was really terrible for me. I didn't understand what I had done, and I felt like it was extremely misleading. So as a consumer, I aired that in a post. Friday, I think it was, and I got kind of lit up from people saying, you consented. Like, what do you expect when you consent? And, a couple things to point out here, and then I'm going to share just a little bit of, some criticism and some suggestions as we try and end this particular part of the show on a positive note, right? Because the three of us are huge advocates for the industry. We're trying to make sure that the consumers have a great experience. We can't always make solid contact, but if we're going to be the best that we can be, we've got to be open to constructive criticism, right? And to me, as a consumer, this is misleading. What Movoto is doing is misleading. Message agent, you put your info in, you expect to be messaging an agent, not going into some crazy lead funnel. Now, some might say, well, why don't you read this? Even in the disclaimer, there's a big problem here. By entering my info and clicking submit below, I'm providing a signature and express written consent to receive marketing email calls, texts, including automatic telephone dialing system, generative AI, artificial or pre-record, blah, 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 right? So there's a lot to this that I have a problem with. And that's why I asked the question publicly, and I'd love to hear in the comments. And I'm okay to be wide open on this. Like, if I'm not right, tell me I'm not right. Maybe I'm way too old school. Maybe go and submit are now the same thing. But to me, if you are going somewhere to message an agent, that's what you expect to do. If you're hitting go, you're expecting to do that action. If you hit submit, that means you're submitting, and then you're wide open. What are your thoughts on this? Erin, you can go first.
I mean, I just cannot stand the constant pinging, phone ringing, emails. To me, it's almost similar to why we beat trigger leads, is because the way that they were communicating to consumers, constantly calling, constantly emailing, all of that, it was abusive and predatory, right? So this to me is similar to a trigger lead situation, where they're just coming and just absolutely spamming the crap out of you. This would make me absolutely not want to do business with this company at all.
Spoils my blood.
Yeah.
We've had to come so far in the last 15, 16 years to restore trust. We still have a trust problem. We still know that most, and we know this from the First Home IQ, Next Gen reports, we know that most customers don't trust our industry. And we've talked about on this show the idea that we need to be uber transparent, over the top, beyond reproach with our customers to win their trust. We need to be meeting them where they are. We need to be understanding what their issues are, the trauma that the Gen Zers have from the Great Recession days. By these kinds of actions where we're putting a whole bunch of fine print there in order to unleash holy hell on a customer with this kind of barrage, not to mention the AI robot voice that called you and wouldn't let you off the phone.
Well, they deny that. They by the way, they deny that. I am going to share a little piece of that here.
But if that person was real, the way that they talk to you is still unacceptable.
Correct.
So no matter what, I think it wasn't real. That's my opinion. But even if it was, that was unacceptable.
That's my opinion too, right? And by the way, it's okay. We all expect to have agentic on the front end. And personally, just so you know, everyone,
just be honest.
I feel like the biggest opportunity for agentic AI is on the front end of the lead funnel. I love it. I think it's the most, and I've told Joe Wheelu this at Total Expert, I think it's the most underutilized, undervalued part of the process. So if it's an AI agent, cool, whatever, right? So in this call, and I want to be sensitive to the agent name, right? So I'm not going to share that here. But this was a call that we both consented to be recorded in the beginning. And I took the call from Virginia where there is no two-way consent. So all I'm going to do here is be very constructive, and I'm just going to play an excerpt from this call because it was so genuine. Like, I was not comfortable. You can tell by the way I'm talking right now. You can tell by the story that I'm telling that this is very sincere. I was a consumer on this call with an agent, and I had an issue with the conversation, and I tried to get off. I said, I'm not comfortable. I didn't realize I hit submit. Can I go now? And the agent just steamrolled me. I mean, I almost want them to tell me it was AI, to say, hey, we're going to make a tweak here and there, but I'm going to pull this up, and I'd love some comments in the comment section.
That's totally fine.
So I'm going to make sure it starts at the beginning. Here we go.
Go is not. That is totally fine.
Yeah.
Oh, I'm sorry. Go ahead.
Well, I was just saying that
Go ahead.
go and submit are two different things. I guess I hit submit, huh?
Yeah, but that's okay. One thing I wanted to assure you is some people take 6 months to a year to get a property, so there's no pressure at all. They're only here to answer your questions. Whenever you're ready, that is, will you also be selling or just buying for now?
Yeah, I'm not quite sure. I'm
Okay.
gonna just take a few minutes to think
were
about
you
this.
looking? Okay. Let me ask you this: were you looking around to potentially buy in the future, or were you leaning more towards rented in the future?
Not-
What are you most comfortable with?
I'm actually not sure. I didn't expect this call so quickly, so I think I'm gonna go now.
Well, let me put it from that perspective. If you were able to find a property that did make sense to you financially, I mean, you really love that property, would you entertain possibly buying a home?
I mean, can we just
is
talk
not-
about this experience? Can we just talk
Yeah.
about this experience for a minute, please? Like people at this company, this is not a personal thing. Please don't make it personal. There's some people on my threads talking about, oh, well, we're going to get, a lawsuit together for what? For being a concerned client and an advocate for the industry? Is that who you want to be? Is that what you want us to be spreading? I'm simply saying that as someone that was on this end of the transaction as a true consumer, not some a-hole mortgage loudmouth that was looking for trouble. I got dumped into the situation and I felt like I was misled.
No, go ahead, Coby.
Well, I don't think we need to make this about this company specifically. I think the statement we need to make is this where we want our industry to go?
Correct.
Is this now, and there are other companies we know stories, and I'm not going to name them by name right now because, I don't want to create a bloodbath, but there are companies that brag about having their agentic AI bots call last November when rates dipped to capture a bunch of refi business. And they bragged about how many brute force calls were made, hundreds of thousands in a day. Is that really where we want to go? And there's a lawsuit that was put forth in February. I know the plaintiff's name was Lamb, and I forget which mortgage company, don't have to name them, but claiming that the AI called him saying they were initiating a callback when the guy never called them, didn't disclose that they were AI. He was living in a state where they were required to do so. It was a TCPA violation. If this is where we're going as an industry, not only will it further erode the trust that we've worked so hard to rebuild with customers, but there's going to be massive, and I'm talking about 7 and 8 figure lawsuits stemming from this if it's not done the right way. And I just feel like, there's letter of the law and spirit of the law. And yeah, you can have a whole bunch of fine print inviting people to click go or submit or whatever, but the customer experience is everything right now. We know that. That's the whole play of the mortgage industry, is figuring out how do we get a seamless customer experience? Is this really how we want it to begin?
Well, and if you take the company at their word that this was a human being, like this is the way they're training their sales agents, like so then she's following like a very real script, right? Like that this is how they train, that we need to be talking and forcing consumers and not letting them off the phone and pressuring them. That's actually worse. To Greg's point, that's worse than if it was AI to me. Like I just refuse to believe that this is how we would train real people, because we do not want to be abusive at all. And if I was, in Greg's spot, if I was just a consumer, if I'm a first-time home buyer and now all of a sudden I'm getting blown up, like what do I think about this industry that I'm now trying to go into? I'm just going to be pressured and forced. We saw 2 episodes ago the Stratmore survey that I showed that from 24 to 25, the percentage of consumers that want to speak to a human has actually gone up. And this is why, because they don't want to have to deal with this if this is AI.
I asked the agent if it was a human being or AI, and the agent said it was a human being, at which point I asked, what's the weather like outside? And the agent responded, I don't know. I've not been outside all day. I work remotely.
So do I.
Oh, and I asked again. I asked again. So you can't tell me what the weather is like outside? No, really. I work remotely. So here's the thing. You can try and bully. We got people in the real estate space that are going into the mortgage space, right? And they have their own way of doing things. In this world, in this town, you got a lot of sheriffs. You got a lot of people that care an awful lot about the consumer, and you will be called for speeding. It's just going to happen. Maybe it didn't happen in the real estate world. Cool. But now you're on a different field with different people policing it, okay? So my suggestion to that company or any other company is be very clear. We already know that there's a stigma around home ownership, and the links in the chain in how people are communicated with. So if I say I'm not comfortable, and by the way, someone from that company went to great lengths to say it was a real person, they dealt with thousands and thousands of consumers, they've done a great job. Was that a great job when I truly was uncomfortable as a consumer and I said I'm not comfortable? Or is that the moment where you show compassion and you actually listen and you say, I'm so sorry, why aren't you comfortable? Maybe there's a better time to call. Don't just bulldoze me. Like, I want them to come out and say, you know what, it was a mistake. It was a system glitch. That was AI, and we do care a lot about what we say to consumers. Like, that would be cool, right? And we're all fallible. Nobody's perfect here. This is not the best point here is Coby's point. This is not about one company. This is about what the future might look like. And we have to make sure as we step foot into this direct-to-consumer world, back into this direct-to-consumer world, we don't regress. We need to progress, okay?
Yeah.
And
If we
that
don't
starts
police ourselves, someone else will.
Yeah, and we've seen that before. It starts with listening. Any other comments on this?
Did you get a good deal on the townhouse?
Yeah, I saw it was pending.
That's not my deal. No. Okay. I'm actually, truth be told, I'm really interested in the house, and I want to click a button to ask, what does this mean? Right? It doesn't say under contract. I mean, I guess being in the business for a long time, it seems to me like you just said that they're in some kind of a contract stage, right? I want to ask, but I don't want to hit the button again because I don't know where that's going to lead. I would say to that company and any other company, just clean up the language, make sure that everything connects. Submit is submit, go isn't submit, and just be very clear and show emotions. If that is a true agent, you've got scripts. It's a total showstopper when a client says, I'm not comfortable, okay? That's 101. You stop what you're doing. You stop right there in your tracks.
Yeah.
Can't be any more clear about that.
Let's do better.
Let's do better. All right. We can move on now, and we can talk about some other things, starting with a topic that Coby has brought to the table. That's LO Comp. Coby, take it away.
Did I bring LO Comp to the table?
I think you did. Yeah. You were Erin. It wasn't me. Was it?
I think it was you.
I think I can go back to that text thread.
Pretty sure it was you.
Don't do that. I think I'm too steamy. I'm in my restaurant shirt, or I don't know, maybe a jailhouse shirt. I don't know what it
calamari.
is.
I don't know.
Do you remember the context in which the LO Comp conversation came up?
Yeah, there's a couple of things. I mean, LO Comp is something that the MBA is actively trying to reform with the CFPB. We're not sure if the CFPB has the bandwidth to take that on. It's not looking like they do. But the executive order that came out from the administration was, we need to make the home buying process in general, and I'm paraphrasing right now, we need to make it more accessible and more affordable. And so the MBA pushed back on that, using that lever to say, hey, there's some things we can fix that can make this a more accessible and more affordable industry, and that's LO Comp. And it's pushing back on some of the TRID reforms and some of the ability to repay, I think, and making it, just a little bit better. There's a lot of compliance issues that we're faced with that are not necessarily beneficial to the consumer. So if you stack that on top of the LO Comp, that's where the MBA went to the CFPB to say, let's address these. And there were three things. I know it was LO Comp, TRID, and there was one other thing. What was it?
Reg X.
Reg X, yeah. So they were things that said, hey, these are not necessarily things that benefit the consumer, and we can attack these things, and we can make this a more approachable acquisition cost for the consumer to buy a home. LO Comp, has been, and of course the NAMB pushed back on it because LO Comp that's reformed on the retail side pushes back on the advantage that the brokers have.
Right.
So there's some structural things that we can do on the LO Comp side to level the playing field, particularly when it comes to like the HFA programs and the DPA programs that are lower margin that we could do more of for first-time buyers that a lot of mortgage companies shy away from. But there was also the broader question about, are we paying loan officers too much in general? We know, for example, that LO compensation is indexed to the loan amount. And we know that the average LO compensation right now per loan is somewhere around $3,200 or $3,300. That's the average commission. 2010, it was 50% of that. And that's directly correlated to loan sizes being twice what they were in 2010 because of home prices being larger or being higher. So are we paying too much? Is that affecting ultimately the profitability of the company? If the average bips that a loan officer is making is somewhere between 87 and 100 on a deal, and the mortgage company is making 16 or 17, is it fair that the loan officer is making 6x than the mortgage company itself? And are we setting ourselves up for failure if we don't address this, both from a global standpoint of how much is the right amount, and from the standpoint of can we be more creative and more effective with how loan officers are paid to make it a better experience for the consumer. So those are the two.
For a guy that didn't bring it up, you had a lot to say. Very impressive.
Well, I was ready.
85 bips, 85 to 88 to 90 bips is where most companies are landing on comp. So the question is, do we keep doing this? Here's your shelf gen, here's your branch, here's your this, here's your that, here's your builder, or do we just call it like we see it? And as an industry have a come to Jesus moment and say, look, the way this works in this environment is let's just lay it all on the table. This is what you're averaging anyway. Let's just call it that. That way we don't have to go back and forth. Erin, your thoughts? I mean, you're running an amazing IMB as the COO of Interlink. Like, how do you guys think about this?
Yeah, I mean, here's the thing: is I think comp should be comp is a reflection of the value that you bring to the organization, and that value is derived based on what type of competitive market am I in, what are the complexity of the files that I'm bringing in, right? And so to me, Coby hit it on the head where whatever any company wants to do within their own market, within their own loan officers to set comp. But the only reason we're even having this conversation is because we have these LO comp rules. We're like the only industry in the country that says you have to fix your comp here and gives absolutely no room for negotiation or being able to reflect to markets that have different competitive nature, markets that have different complexity of products, different variety of products. And so that's why I'm proud to be part of the Mortgage Bankers Association that is actively going after LO comp reform, because we should be able to not have to say across the board, we're all going to do $1,000 a loan, or across the board, we're all going to do 85 basis points. It should be how normal incentive compensation is set, which is a reflection of the value that you bring to that organization. And that decision and equation should be made between the loan officer and the company. Yeah.
Well said. All right, Coby, I'm positive you brought this up. Now, you didn't make this slide. I made it. It's a very busy ChatGPT slide. Now, I paraphrased what you said. We were having a conversation. We do our pre-production meeting. And we were talking about brokers and lenders and cross functionality and blending. And why did you bring this topic up? And what do you want us to talk about?
I'm still trying to figure out what's going on here.
So busy. It's like a used car commercial.
All right,
where do I start on that?
Well, no, we'll take it off. I mean, I just, I threw it in GPT.
Are you talking about the broader platform conversation?
Yeah.
Okay. Yeah. So, last week, I think it was the end of last week, there was a story in National Mortgage News about Nexa acquiring Copper Ridge Ventures, which is a holding company for JVs. And of course, as soon as Nexa does anything, everybody from the rafters starts to shout, are they retail? Are they broker? Which one are they? And they make them kind of defend their position and who they are and define themselves in a certain channel. And the post that I put out that day was, here, Nexa's done yet another thing, and they've expanded their platform. At what point do we stop asking the question of, are they retail or are they broker? And do we start asking, does the future of mortgage look different? Is it more of a platform where there are multiple channels and there's multiple ways for a loan officer or a real estate company or a JV to plug into an existing infrastructure and manufacture production? And I think that it speaks to the broader question of, what do we look like in 5 years? What do we look like in 10 years? Every week we come on the show and we talk about another element of profitability in the mortgage business. And we see that profitability quarter after quarter shrinking. It's gone from 21 basis points to 17 basis points to 16 basis points. And yes, 76% of companies are still profitable, but that profit margin is this thin. And if we don't start thinking about what we look like in 5 or 10 years and how we manufacture loans in a different way, and yeah, AI is part of that. But what, do we really need to keep defining the broker channel versus the retail channel? Can we gain more efficiencies if we start thinking about things more broadly? And what do things actually look like?
Well, I think it's the, natural progression. It's broker to banker. That's what it is, right? But as we're seeing consolidation, more and more consolidation, I think we're going to absolutely start to see changing business models, trying to capture market share as much as you can, because we're just going to see bigger and bigger players come on.
But that progression you're talking about, that's what it historically has been. You start out as a broker, you do enough volume, start to get a warehouse line, you do non-delegated, and then ultimately you hire processors and underwriters and you're doing the whole thing. That has been the traditional path.
Correct.
What I'm asking, and what I asked in my post is, does that traditional path, is that what it's still going to look like in 10 years from now? Or Are we going to see a more of the platform model where you have the different routes that a loan officer can come in and do business? Are you going to incentivize them for servicing? Even though we know that there's holes in that, but are you going to have a non-delegated channel, a broker channel, a full retail channel? Can you have all of those things existing at the same time and be much more diverse and perhaps make more money than what the traditional path has been?
I think you have to survive.
Well, some do. So that's been happening for a long time. Some companies do have that value proposition of sharing servicing. Some companies do lean heavily on lending, but then they allow you the opportunity to broker. What's interesting around the brokers are better movement is there was a time where there were, staunch advocates of the broker channel coming on all platforms to say that the line of demarcation is if you have a warehouse line, you're not a broker. But now it seems as though the majority of the brokers that are doing anything in numbers, they've got warehouse lines. So what really is the difference at this point, other than the fact that the brokers are capped and the lenders aren't in terms of revenue, Coby?
Yeah. I think it almost feels like whenever I hear are you a broker or are you a banker, when someone gets that warehouse line, it's almost like retail having their day in the sun. Like, you wanted to differentiate. Oh, well, and now you're one of us. So, you're no longer, Andy Harris is one of them. As soon as anybody even, dials the phone number for an account exec at a warehouse line, he's like, well, you're no longer one of us. Now you're retail.
I think that's fading. That's fading, though. That's fading.
I think it should sunset, and I think it should fade, and I think we should be talking about things more broadly. And I mean, even the fact that we have the NAMB pushing back on the MBA for LO comp reform because they don't want to lose their arbitrage advantage. I think that's bad for the industry. I think we should think of ourselves more, more nimble, more diverse. We need to be thinking, and that was my post about non-QM too. We need to be thinking about what kind of different products we can offer. We're clearly voluming ourselves into extinction, because the more loans we do, the higher the cost goes up, and the shrinking of the margins, and that's going to put people out of business. That's the trajectory we're on right now. So if we don't change that, if we don't start to think about the industry differently and how we can provide more value to loan officers and through that consumers, we're going to see that 76% number of profitable companies go down very rapidly. And obviously the consolidation will happen as a result.
Yeah, and I think that's just it. Like we're currently in a phase where our entire ecosystem is rapidly changing, and I think that we can't expect things to operate the way that they always have been for that exact reason.
Yeah, I have a prediction to make here. I think that Rocket is going to break the seal here as a broker platform that brings in true retail. I think they're going to lean into. I don't have any intel, by the way, but I think that it makes sense for them with all the horsepower they have with leads, with all the servicing, 1 in 6 loans and everything else that they have, all the efficiencies, all the AI, probably the lowest cost to produce out there, one of them anyway. It makes sense for them to look at the IMB space, because that's billions and billions and billions of dollars. They can accelerate that timeline that Jay and Varun talked to you about. Jay Bray from Mr. Cooper and Varun Krishna from Rocket. I had them on about a month ago on my podcast one-on-one. And I asked Jay, how long until you can confidently say you're bringing in every single lead that you have the power to bring in through all your channels? He told me 18 months. That's got to drive him sick. Like, how do you accelerate that? There's one way. You go and you grab some IMBs, because you can't control the broker channel and hold them accountable the same way as you can lenders, right? So if you go acquire an IMB and now those loan officers work for you, you can say to them, hey, when you get a lead, you need to call that within 30 seconds. But you can't say that to a broker, right? I mean, you can say it to them, and it'll flush out in the results, but you can't. That Rocket loves to drill down on metrics.
Well, I'd be interested to hear how IMB loan officers, if they stick around to be a part of that model. Like you can acquire the IMB, but does that mean the loan officers are going to stick around?
I think, yeah, unless something dramatically changes on the volume and the rate environment.
Well, you also don't need 100% buy-in. You don't need 100%. If you buy an IMB, you don't need 100% of those loan officers buying into your, if you don't pick up the phone right away, you lose the lead. You just need a certain percentage of them that you control. And if that's 5% or 10%, that's great. You've got your control, and the rest go out and do the business the way they've always done it. So I absolutely the play they should make, and I think they will.
Well, the X factor, Erin, is that you've got a feather in your cap for recruiting in that model that you don't have, and that I don't necessarily have at NFM either. I'm not saying you don't have it. I'm just saying, as IMBs that aren't tethered to a company that has
machine.
massive, like a lead machine. Now, if you're there, you can say to loan officers and branch managers that your world's not going to change at all. It's going to be the same. The economies are going to be a little bit better, right? But now we're going to actually give you leads. We're going to pay a little less on them, but you're going to be able to build your business in a very intentional, different way. And that book belongs to you when people end up refinancing and stuff. So it is an interesting time in our industry. I'm not sure, Coby, that in 5 or 10 years, how much different it's going to look. I think that's a conversation for another day. Certainly something we all spend a lot of time thinking about.
Well, we've got one of our topics today that actually might lead right into that and change the landscape. I don't know if it's next or coming up, but the whole IMB and Basel III and what that means for IMBs and bank relationships, that could change the landscape in 5-10 years. There's a lot of things that could happen. A lot of things that will happen.
Yeah, absolutely. And if you want to jump right into that one?
Yeah, Erin, you're the lead on this.
Yeah, I mean, I thought this was a really interesting article that I saw this week about, would the changes to Basel III potentially make IMBs purchasers of banks? And no, I don't think, on the whole, that's not going to happen. But I think there are some companies, and I think Rocket being one of them, where potentially that could make sense. You have access to, better access to funds. You've got the Federal Home Loan Bank. From a licensing regulatory perspective, what does that look like? Does that make your lives any easier? And so I think that there could be a play where potentially a freedom, does Stan want to be a bank? Seems natural for him too, right? And so, I think it's a really, really interesting play and proposition where I don't think, Interlink is tomorrow going to go want to be a bank because we could potentially get better MSR values, right? But I think there's a lot of these larger IMBs aggregators. So you go from broker to banker to depository, right? Is it just a new extension of the growth model and where that goes? And I'm wondering, the PennyMac Cenlar acquisition, as part of that, Cenlar is getting rid of their bank charter. And I'm wondering if PennyMac is, if they're regretting that, or if they're rethinking that now with potential changes with Basel, and if that could have benefited PennyMac. So I'm interested in if they've had a change of heart on that.
Erin, this is not an area that I'm an expert in. I know maybe enough to be dangerous. So, if you can break this down in a very rudimentary way for everyone out there, because some may think to themselves, I thought we killed Basel. Like, I thought that all the things we didn't want ended up not happening. Why are we back at the table, and why as IMB should we care?
Yeah. So, so Basel III, the, quote unquote end game, the proposal is out there. I think the final commentary is due next month in a few weeks. Mortgage Bankers Association is all over it. I know that Bob's been talking about it, testifying about it. They're working on their written responses to it. But basically, it's changing the way capital rules are working for banks, specifically the one that a couple of them that are important. One is on the MSR, the risk weighting on MSRs. They have it at 250%, which is basically, it's been really, really bad and negative for banks. And so they're saying the proposal basically said, what should the risk weighting be? And I know MBA is coming out and saying it should be moved down to 100%, which is significantly more favorable for holding those assets on your books. And so, now if holding MSRs has a more favorable capital weighting, the article basically just said, okay, now would it make more sense for IMBs to try to go be banks, be depositories? That could help, make it easier to make that conversion to being a depository, which that also opens you up to different lines of access. You can bring checking accounts, you can have the more complete loan. There's a couple, several other, items with the Basel III reforms as well, in terms of lowering risk weightings for loans with MI, in terms of warehouse banks. And I think that's good for IMBs, even if you're not talking about IMBs buying banks. this could ultimately help IMBs with bringing banks back into warehouse lending. There's been a lot of consolidation there. So could we maybe have more banks come and competing for our business, giving us more favorable terms? Could we have banks come back into the aggregator space? Can we get a Wells Fargo back buying more loans, get Chase buying more loans, that kind of thing? And so I think some of these changes that have been announced, and there's a lot of material out there that you can do if you want to do a deep dive on it. But I think there's a lot of really good opportunities here to help IMBs, regardless of whether or not they try to be a big boy and buy a bank.
That's amazing.
I have a
Coby?
question. Yeah, I have a question for Erin on this. So if the way that it might negatively impact is with more competition with MSRs. So wouldn't that put some of the pressure on a Rocket or a PennyMac to want to get involved in the banking side so that they can kind of achieve those efficiencies as well?
Yeah, no, absolutely. And that's why Rocket is number one on my list for it. And I'm really curious as to what the conversations are at PennyMac about that Cenlar charter.
Very interesting. Anything else
Yeah.
on this?
Yeah, I mean, the just, a reference to the post I wrote about, how the moat is going to be the non-agency products. And while there's certainly some cause to be concerned about where some of those are going, that's the part of the industry that I think the banks are never going to touch, even if they do decide they're going to get back into the servicing. But if they do decide to get back in mass into originating beyond just their own customers, which is what they're doing now, they're going to want to be still doing jumbo loans and portfolio lending. They're not going to want to get into the non-agency stuff. So that's an opportunity to expand. That's I think another moat that we need to look at if you're IMBs or brokers against the banks potentially coming back into the business.
With the diminishing pie, though, why should an IMB welcome banks getting into origination? I know we've talked about this before, but some people haven't heard us talk about this. So if you're out there listening, you're probably thinking what I'm thinking. Like, it's already a dogfight out there. We're already making less, doing less opportunities out there, and all of a sudden now we've got this possibility that banks would want to get back into mortgage when we know they just go in and out whenever they want to. That's not going to change. So I love the things that you said, Erin. It's so insightful to think about that potentially there might be some better warehouse facility lines, that maybe there would be a competition, a race to the bottom. It could be cheaper for everybody. All that, maybe the banks there'll be a race to pay up more for MSRs. Like, all that is really positive. But as an IMB, you don't keep your doors open. You don't keep your lights on unless you're originating loans. Coby, why should we welcome banks into that space? Is there not enough competition out there already?
There's plenty of competition. You're looking at it, though, from a static market standpoint. If the market stays static and there's no new entrants and we're not building more homes and we're not creating more vehicles for people to own homes, then yeah, obviously you want less competition. But more competition equals more innovation, equals more people coming into the market potentially. The banks will probably do loans that the IMBs don't want to do. The banks are more likely to do down payment assistance and first-time buyer loans, where the IMBs, it's not as profitable for them, especially if we don't reform LO comp. So there's the possibility that new entrants into the market could grow the whole pie. And then there's more homeowners, there's more opportunities for refinances, and there's more transactions happening. I think if you look at it from that standpoint, we should welcome them.
But historically, Erin, banks like to portfolio things that IMBs can't get their hands on.
Yeah.
So that makes it like double jeopardy. It's like a double threat.
Yeah,
not?
but
They're still doing those loans, though.
Yeah, they're still doing those, and I think the fact that there's still a ton of reputational risk in mortgage origination for banks. I still think that if I'm a bank, the smart play for me is buying the MSRs, doing the warehouse banks, eliminating having all that market risk, the volatility, the reputation risk, and so I could be wrong. I'm wrong every freaking day, but I just don't see the banks coming back to origination like on a large scale. I think there's far more opportunities for them to do it in other ways where they can benefit without exposing themselves to the risk that they just don't like. And, you've got some of these big banks just coming out of their consent orders, and they're not, I think, going to be eager to jump back into that. And IMBs are the ones who have been here through thick and thin, and we've continued to serve the markets well. And I think that we're going to continue to be able to do so. And I think we can compete, and I think we compete on service. And I think we can show that we truly are the ones who understand our communities.
Yeah. And there's 4,000 community banks out there. Each of you could buy one for Interlink, one for NFM.
Listen, let's go.
To me, when I think of banks, I don't put enough weight in the community bank aspect, because that, to me, I'm all for pouring into that more. I just think about the larger banks, right, that have all the clout and all the power, the JP Morgans of the world, the Wells Fargo, Bank of America at one time. Like, we saw what happened when things fell apart. But yeah, community banks, you guys have brought me from, and this is what I love about this interaction that we have. You brought me from the complete left a little bit over the middle on this. I'm feeling it, and I appreciate all of the insight on this topic in particular. Erin, you're up again. Can you believe it? You're bringing up the caboose here. Great job here. You wrote an article here on the appraisal changes, and everybody stop what you're doing. Like, this is a very, very big deal. Erin educated me a couple of days ago on this, and it's a real showstopper.
And what a great picture in that. I mean, it's a very small thumbnail, but that looks like a really cool, great picture of you.
Well, thank you. That was that we actually took that. My friend Dustin Pfluger's wife, shout out to Ashley. She took that headshot for me at the annual convention. So I've had my prior headshot since 2021. So
Cool.
good.
I like the off the shoulder action.
Thank you. Thank you.
Greg, what do you think? Greg, what do you think? Did we see you in an outfit like that next week?
It's very possible.
I mean, you went full blanket today. I think showing a little skin next week.
I can't see that well, so I'm having a hard time here. It looks like part of the shirt is missing though.
Yeah.
So I hope you find that wherever
I'm
that
gonna
went.
put that on my Hinge profile. That's my new profile picture.
I like that. I mean, are you really on Hinge, Erin?
Okay. Yeah. No. I started to do the profile, and then I just can't do it because I don't know how to write about myself. I'm not about to make AI do it. And pictures where I think I look cute, people tell me I look dumb.
You know what?
So
what if you put this article up as your bio, and maybe an appraiser who's now got a little more time on his hands might.
Listen, I spent 12 years with an appraiser. I'm done with that.
Oh my goodness.
No.
Yeah. The value didn't hold up on that one.
Yeah, correct. Yeah.
Oof.
The quality rating wasn't as advertised.
Yeah, bad joke. All right. Back to business here, because this is serious. Like, this could really.
Yeah.
You think that it's possible that a bunch of appraisers could be leaving the business as a result of this?
Yeah, it's something I'm really concerned about, right? So this changed over to UAD 3.6. We have a brand new appraisal form coming later this year. And it's a big deal because it's one that's being kind of pushed on the appraisal industry from FHFA as part of their, uniform mortgage data set that we in the industry in mortgage have been dealing with for years, right? Aligning, making everything look alike, consistent, basically finding a way to report data consistently. And so this change is now coming for appraisers, and a lot of them don't like that. It's requiring them to get completely new software, make investments in new software, completely learn a new form, completely change how they write reports. And so, I'm hearing that's, upwards of 10% of our appraisal stock who they're not exactly replenishing at a high rate anyway, that they may just completely opt out and either retire or just work in spaces where they're not having to do the new form. So portfolio lending, that type of thing. And so, what happens if we lose 10% of our appraisers? I think we've already been pushing them out, for lack of a better word, with the amount of waivers that we're doing, right? And the value acceptance and the PDRs and all of that. And so if we lose 10%, what does that mean? And so, I'm concerned about that and what that's going to look like. We're clearly, just like I said earlier, we clearly are undergoing massive shifts in all aspects of our ecosystem, and this is one of them. So if you're a lender, if you're not paying attention to this or you're not really focusing on it, you really need to be. And chatting with some of my appraisal partners right now, I mean, I'm hearing that only 25% of the appraisers right now are able to do the new form. And so if you're trying to convert now, that means you have a much smaller pool of appraisers to choose from, which means your appraisal fees are going up. So now I'm hearing it's also another $50 to $100 per report. So this is something that is affecting us. It's affecting costs, at least right now. It's affecting our appraisal pool, which could impact service levels. So we just need to be paying attention to it. And if you're not in your company right now, then you're behind the 8 ball.
So during this discussion, we had the conversation about the government getting more heavily involved in this business, Erin. So, or Coby, one of you guys want to touch on that? And I think it really salient question is, what does the appraisal industry look like in 3 years? Is there even an appraisal industry out there, or is most of this done through automation, sans the outliers?
Look, we live in an age of data. The data that we have, the data points that we have are overwhelming. We look at just, Fannie, how they underwrite a loan, 200 points of data. They're not even looking at the score. They're ingesting 200 different points of data about that borrower to make a decision. There is no reason on earth we should still be sending, and I know this might be an unpopular opinion, but there is no reason on earth. I mean, I guess there's some reason, but generally speaking, for most homes that we finance in this country, conventional at least, we should be moving there to FHA. There's very little reason to send a guy out there with a tape measure and one of those rolling things and on a digital camera that he's got to upload pictures later and send this 12-page report. This is the first step towards modernizing the appraisal process, towards getting better data on housing in general that's less biased. Not that there's a ton of bias, but anytime there's a human involved, there's bias. So I'm not making some kind of broad claim that appraisers are.
Well, there's also there's discrimination bias too. If you ever talk to Nikki Bialka from Fifth Third Bank, that's a whole nother conversation.
Yes, and that's why I didn't want to touch on that, because there is a claim out there about, but I wasn't talking about discrimination bias. I was talking about just the human in the loop bias that happens. So in my opinion, this is a great first step towards, and we've tried it once. We had Fannie, day one certainty, and we do have, I don't know what the percentage is. You guys would know better as operators what the percentage of appraisal waivers are. It's getting better and better and higher every single year. This is a step towards that. If we lose appraisers as a result of this that are retiring out, so be it. If they want to adjust to other positions in the industry, we welcome them. But this is no disrespect to anybody who's in that profession, but this needs to be modernized. This is a great first step towards that. I think what a great step in the right direction for the customer experience. If every single one of these appraisals is some sort of automatic valuation where we're not waiting for somebody to come back, think about the cost savings. What is the average appraisal cost now? $700-800. So these are ways that we can make the mortgage industry more affordable and more sustainable for the operators and more affordable for the entrants as the consumers go. So I'm all in favor of this. This deadline, I think it's November 2nd?
November 2nd for new submissions to UCDP.
For new submissions. I mean, is that going to stay if there's, 70% of the companies are not ready? Are they going to push that back? I mean, they have a history of doing that with other things. TRID, I think, was the one thing that I remember that had the hard and fast date that they didn't diverge from.
Yeah, no, they did.
Did they? Okay. All right. Yeah. So, so I guess they've never diverged from that. They've always pushed back the date when they've realized, but you have to put a hard and fast date. You've got to put pressure on the industry to change. And I'm all for it.
It's going to be a rough transition, because we're still at a point where we're not going to have waivers on everything. And so for those of us who are in the space today, regardless of what it looks like in the future, we've got to make sure we're prepared for it. I think there's always going to be a place for appraisals. You're always going to have portfolio. You're always going to have, potential value issues. And then there's also consumers who use the appraisal as a negotiating tool, right? I mean, I know there's times where they get a waiver and they still opt for a full appraisal because they think that they can use that value to negotiate. And so if we ultimately, get rid of all residential appraisers, then how do consumers lose their ability to negotiate on that? Do they? What will be their route? And so I think there's still a lot to think through as we go through the next few years of what that appraisal industry is going to be like, and does it make consumers lose a negotiation ability?
So lastly, U.S. and Iran reached tentative deal, but Trump must still sign off. This is a headline we should just touch on quickly as it relates to the mortgage business. Like, what if there is a settlement here and the war ends? Obviously, things are going to change for the better, you would think, drastically in the mortgage industry. So I know you all welcome that, right? Lower gas prices, potentially a falling bond, unless too much damage has been done on the inflation front. Obviously, inflation's hot even without this. So I guess we cross our fingers that it's going to come to an end here.
Yeah, I don't know anything about this. I work from home. So as you know, I work remotely.
Aaron, do you want to put your hat on?
What are you talking
backwards?
about?
Backwards, Aaron. You want to put your hat on backwards? You have a hat there.
Yeah. Look, this has been. This is dragging on. As and
the show or the war or both.
The war.
Get my blanket back on here.
Get your
Hello
blanket.
from
Well, I mean,
the
look,
other side.
if the war doesn't end and oil prices go up, how are you going to heat your office? So you may need that blanket.
Yeah.
My
So-
landlord's kicking me out, by the way. He claims that I broke his condenser on the roof. 20 grand, he said it cost him because I've got the only thermostat in the building apparently, and I'm one of those people whose feet they're constantly freezing. This is what happens when you get older. You two don't know yet. You're still south of 50. So I have this little space here, and he claims that the thermostat got confused and it sent some signal up to this $20,000 compressor. So he has kicked me out. He has given me notice. So I'm gonna have to redo this. Maybe I'll just put no surrender back here.
Oh, yeah. There you go.
What do you think?
I like it.
It could
I
happen.
like it. I like the war ending. I like that. Let's all of it.
All right. Well, it's been another great show, our third in a row. Are we going to continue this? I mean, I know we said it was a 3-week trial. I don't know. What do you think? You're medium?
Oh,
You going up? We going up? You going down? I don't know.
going up.
I think we're going up. Any closing thoughts?
Yeah, I'm really enjoying doing this. I'm really enjoying doing this with both of you. I just want to say it. Greg, you said it was the highlight of your week, and it's quickly become mine as well. This is a lot of fun, and it's great to do deep dives on some of the topics that both of you bring up and to get ready for the show. So I appreciate that. I would love more audience participation. Tell us what you want us to talk about. You know how to reach us. We're all over LinkedIn. You could find us. So we'd love to hear from you what you want to hear about and what you want us to talk about, and we're happy to do it.
There are
Same.
comments, that we've not covered.
Well, let's get a couple.
We have to do a better job covering these comments too.
Yeah.
Suzanne Caldera, kind of pimp-like. I'm not sure what that means. Maybe that's because of the blanket.
I didn't know with the blanket. Yeah.
Yeah.
Yes, I think so. We'll get you like a pimp chalice.
Okay, there's this one. That's also from Suzanne. When you consent, you don't expect to be stalked like a psycho ex. We've all had those. Yeah, facts for sure. I guess this was on that conversation. Definitely got people fired up.
Mm-hmm.
Yeah.
Let's see. All right. We have to thank Nayoung Chu too. She's pretty amazing.
Oh, she's the best. We love her.
She's the glue. Best part of this.
I like Drew's the best. You guys, Erin, do you know Drew? I know you know Drew.
I need to know Drew.
Yeah, he's a big wig at Guild. He's a great guy. So down to earth.
Yeah, we love
Bill
Drew.
Dolly, your guy. I mean, this guy loves you. Another
Bill
show.
Dolly's the best. Like, this dude is legit. He is awesome. I love him. I'm so glad he's watching.
I think at this point he may be on your payroll. I mean, this is like your biggest fan.
I'll take it.
I mean, that could have been directed to me. You don't know.
True. All right.
Fair.
We
Good
will
night.
do this again all over on Thursday, a week from today. Looking forward to it. And Coby, I think if nothing else, you learned your lesson today to not drop a topic in my lap and leave it to me to come up with a graphic. So this week, your graphic game was probably just a straight F. I'm not even going to call it a D-.
F.
Very little participation in the graphic department. So hopefully one and done there.
Short week.
I understand. You were out there saving the world. All right, everyone. Take care. Enjoy the rest of your week. So long.
Bye.
No surrender on the show. We go toe to toe. What's fair? What fails? Who gets the own? Hot news, hot takes.